everyone. Welcome and thank you for joining our webinar today. This is Jyoti here, and joining us today along with me, it is Sudhir Pai. Before we begin, I would like to take this opportunity to introduce you to MyTime Equity and Sudhir Pai. As an actively managed portfolio management and RIA firm, MyTime Equity takes pride in being your dedicated partner on this financial journey, helping you to plan, grow, and preserve your wealth with confidence. Sudhir Pai is a founding principal of the firm and serves as a fiduciary investment advisor representative, bringing deep expertise in wealth management and tax efficient investing. Before I hand over to Sudhir, let me take you through the disclaimer slide, which our attorneys mandate we show prior to every webinar. Kindly scan the QR code to join our MyTime Equity WhatsApp community to get exclusive updates on equity markets, alternative investments, real estate, crypto, ventures, and many more. If you have any questions during the webinar, please type them in the Q&A box and we'll be happy to address them during the discussion. If you like to connect with Sudhir after the session, you can reach us at wealth@mytimeequity.com or call us at 972-330-2771. Over to you, Sudhir.
Thank you, Jyoti, and very welcome, ladies and gentlemen, for joining today's webinar. Today, we are going to talk about Magnificent Seven and what's happened in the market last week. So the index was kind of up and down, but finally we saw a green week. S&P 500 was up 0.14%, while NASDAQ was down 0.14%. It's kind of a coincidence, but the numbers look the same. Bitcoin really took it on the chin. Pretty bad week. You know, from last 2 weeks, we are seeing Bitcoin really take it directly on its chin. It was down 9%, and gold had a comeback, was up 2%. And silver did very well on Thursday, but on Friday it was down. But overall, silver also gained very well during the week. As you can see, the chart, you know, both the weeks from last 2 weeks, S&P 500 touched, you know, the 50-day moving average. That means the price went back 50 days, and then again it pulled back. So the market is in a mood to pull back, but there are way more bears than the bulls. So it goes down all the way to 50-day moving average and then comes back up. So this is a good indication. The other good indication is that, you know, the market is broadening, which means, you know, it is not just the 7 magnificent technology companies that are doing well, but the other 493 companies have also started gaining some momentum, and that is a good sign which we are able to see in the equity markets now. And that's what I'm going to cover today, because the rise of the rest of the market is what is very important for this equity market, because the Mag 7 has gone up way too high over the last 3 years, and we want others also to follow suit. And given that the interest rate cut has happened once, and why did the pullback happen on Friday, right? Why did it happen? What is the reason behind it? The good thing is, you know, the government shutdown has ended, but it has been the longest US government shutdown, and it did start affecting the overall economy, primarily because, you know, government employees were not being paid. Spending went down. The anticipation is that GDP numbers for the last 30 days is not going to be very good. It will be down by about 1.5%, and the market took it as you know, something that has is history now, and it did sell off primarily because, you know, the interest rate cut, the tone that most of the Fed governors have been kind of highlighting right now over the last 10 days since Jerome Powell kind of did his interview during the FOMC meeting. He was very clear that, you know, don't take the December cut to be granted, as a granted decision, but it's going to be based on data. So that is what has been echoed by the other Fed governors as well. And the betting markets are right now bringing down the December cut expectation to 50% from 90%. And that's the primary reason for the sell-off that we saw on Thursday and Friday. But since the market touched the 50-day moving average, we saw the pullback. But Friday morning was really bad. The first 30 minutes, 1 hour of the market was really, extremely bad. And I was like, this is maybe going down further. But let's be patient and let's see whether it bounces back after it touches the 50-day moving average, and it exactly did that. So what does this mean? This means understanding the technicals that are going on in the market is more important than the fundamentals and the macro news that we get to hear, because there are a lot of bots playing out in the market, a lot of institutions trying to buy in this market because they have only 40 days to kind of come closer to S&P 500. Otherwise, they will not be able to charge fees to their clients. So all of that is playing on the market right now. So it's going to be very interesting next 40 days. But I'm extremely positive. And the other reason is because we are also good with the Q3 earnings, 13% growth so far, and the 2026 earning expectation is extremely good with 16% year-on-year growth. And volatility continues. And as I said, the 15-day moving average got tested on November 4th, November 14th, and before that, November 7th. And that is what gives me comfort that the market goes down a little bit and then pulls back up. So that means the bears are trying to take control, but the bulls are no less. They are also trying to see how to get back in with more money and try to keep the year going. Next slide, please. So we did talk about this point as to why the week was down. It was the government shutdown, 43 days long, not good for the government employees because they don't get paid, and not good for the stock markets because of uncertainty. Data doesn't come from the labor market, labor department, and other departments which on a weekly basis generates a lot of data, for the market to kind of react. And equity markets, they are all about certainty and uncertainty. So if there is uncertainty, then there will be a sell-off. If there is certainty, markets will start going higher and higher, because equity markets, when the earnings are good and when inflation is not lowering, overall bullishness in the market is always good. And the third reason is the hawkish Fed, because of the not giving any kind of comfort for the December rate cut, and the betting market also now showing 50% probability for the December rate cut. In my personal opinion, I think the rate cut is imminent. It is going to happen, 25 basis rate cut, because otherwise we will see a lot of sectors not going to perform, and rather going to see further decline. Interest rate cut has to happen, otherwise there will be a lot of blood on the street with respect to real estate, particularly next year. A lot of loans are coming due, and if interest rate cuts don't happen, if Trump's 30-year mortgage to 50-year mortgage change happens, all of that is going to give a lot of push to the real estate market, and we should be able to see real estate market pick up again. And we are seeing that in the equity market. The real estate companies are kind of coming back. We are not seeing the same level of drawdown in the rest of the stocks other than the tech stocks right now. Next slide, please. So the Max 7 holds almost 35% in S&P 500 and almost 45% in Nasdaq 100. And as you can see, year to date, S&P 500 is up by around 15%, and only Google, Nvidia, and Microsoft have outperformed the S&P 500's overall return. Whereas Apple, Tesla, Amazon, and Meta actually underperformed the S&P's 15% and QQQ's almost 20% return. But it's only Google, Microsoft, and Nvidia which has been doing extremely well. This reminds me of the structured note that we did last year, with the 4 companies, 4 Magnificent 7 companies, and that structured note had a 50% return at the end of year one for the stocks being flat or positive. And most of our clients really really like that note participation. And we currently have another note which I'm going to take you through. So all of these notes really will give you a better return when there is such uncertainty in the market, and you also need the protection on the downside. And that's what the note is intended to do. Give you a extremely good return. So we are not extremely greedy there, happy with what we make. And on the downside, we have up to 50% downside protection, which is pretty good downside protection when it comes to equities, particularly individual stocks. But what this says is Max 7 holds majority. So even if so much of money goes in the index, these 7 companies have a lot of weight. So all the money that you invest from your 401k plan or from your HSA or from your 529 plans for your kids, all the endowments, family offices, if they are buying just S&P 500, all that money goes finally in these 7 companies. So these 7 companies will continue to do well, but what it also means for the other 493 companies to do well, that means market is going to do better and better as we see that participation in the market of other companies doing well. Next slide, please. So if you look at the equal weighted index, what's the difference between equal weighted index and market weighted index? Market weighted goes by the price of the stock in that particular index, whereas equal weighted means it does not really look at the weight of that particular stock in terms of price over the way the indexes buy. So the equal weighted index and the Dow Jones, have because Dow Jones does not have a lot of technology companies, right? They are more old economy stocks. So Dow is up by about 11%, and equal weighted S&P 500, which is also represented by a ETF called RSP, that's up 7%. And equal weighted NASDAQ 100 is represented by QQEW, which is up 11.8%. So it's not that these 3 indexes are also not performing. They're performing decent, but there is a lot more growth to happen, right? So that means we should be able to see the broadening of the market helping these indexes. And the other thing is, even these 3 indexes are at 2 to 4% from their all-time highs, because the market sold off over the last 2 weeks. If you add 2 to 4% to all these numbers that you see on the slide, you will be able to see what's the all-time high of these equal weighted indexes. So it's not just the tech playing out there, but the other companies have also started growing. And because of that, that's a good sign, for the market to have broad participation, right? Because broad participation is always healthy. If only one player in the cricket team plays well, other 10 don't, that's not good, right? If all the 11 players do well, the team has to win, unless the other team also has equal participation from all the 11 players. And luck always matters, but participation from all the players always is good for that particular team. And that is what I'm trying to highlight here, that the indexes will also continue to do well, which means the other companies, not just Max 7, has to do well in the next 1 to 2 years time. Next slide. So seasonality and history, seasonally, when we have 6 straight months, which is May to October, doing well, we see better months of November and December. The median return that one gets to see, if you take the data since 1928, it's about 5.4% additional return that you will get to experience if you go with the history. Past performance is never indicative of future performance, but it is certainly a guide. So we could still see the probability of 2025 year ending strong is very high, even if there is a lot of noise in the equity markets because of the AI bubble, Fed not lowering the interest rate cut, and the circularity of money that is flowing, between all the tech companies, with OpenAI doing deals with multiple companies, and all of that. Private credit, going through one or two challenges because two or three companies went bust in the private space, and that again led to some amount of bearishness in the market, certain concerns. Crypto market falling, Bitcoin is usually a leader for the risk on equities. So Bitcoin falling so much is always a concern because it always is the lead to equities. And does this mean that the next wave is for the equities to fall? And then government shutdown, which finally ended. So all of these negative news, right? And SoftBank, another news that hit the market is SoftBank selling Nvidia stock. And the reason for that is to invest in OpenAI. So it's not that bad that a large venture in a private equity firm taking money out of Nvidia because they want to take some chips off the table and investing that in OpenAI doesn't mean they took the money and kept it in cash like what Warren Buffett does, right? Even Warren Buffett invested about $5 billion in Google yesterday. So there is a lot of good news, but at the same time, all the bad news get highlighted. And given that we have seen extremely good 2023 20% return, 2024 20% return, and 2025 so far 15% on S&P, all of that makes people feel that, oh, this is going to be a big correction, right? Because it has gone up so much. But what happened in 2022? Market was down for almost 22%. What happened in 2019, and before for 10 years? After 2009, after the global financial crisis, 2008 was down, 2009 was down, but it came back up. But 2010 to 2020 till COVID happened, market was really good. So 10 years, market really did well. So it's not that 2 years of double-digit growth means market is going to crash. But that's the fear usually people carry, right? If you invested $100,000, in 2023, today that will be close to $200,000, right? Depending on your investment in index or stocks, it can be anywhere from $200,000 to $300,000. So the question is that person going to fear, oh, if I continue to keep this, will my profits go away, right? That is normal. But is that what will happen, right? That is unknown. That's the uncertainty of the market. And that's where active participation plays a major role. That is where looking at all this data, taking a data-driven approach, using fundamentals, technicals, seasonality, and macros is extremely important. So one has to keep watching. As I said, I am not concerned because we saw the dip going all the way up to a certain level in the charts and then pulling back up. So as long as that trend continues, it's above going higher than the 50-day moving average, closer to the 20-day moving average, I am super comfortable with keeping all money in the market without having to take it out. Right? And for new money, we have options, and we can look at those options after the next slide. Next slide, please. And folks, if you have any questions, please type it in the question and answer box. We will be answering the questions real time. And if there are too many questions, then we'll take those answers via email. But there is an option to type your questions in the chat box or the Q&A box. So please type your questions there. Coming to macros, the FOMC meeting minutes is going to be released on Wednesday. And crude oil inventories, we are seeing crude oil prices fall, oil prices falling, and that is good for inflation. That is good for people to spend more towards other things. So that's a good sign. And we are going to get results of existing home sales for October. They're expecting about 4.6 million homes. We'll see how it goes. There is a lot of concern in the real estate market right now. So that's where the interest rate cut will help. And then on Friday, we have the manufacturing PMI and the services PMI for November. So those numbers also play a major role in how the market behaves. So a positive services PMI is always good for the market, and positive manufacturing, now that a lot of data centers are getting built. Eventually, I think that also is going to become a big deal for the United States of America. Next slide, please. Our portfolios, because of Bitcoin, took a beating. While S&P was up 0.14%, our custom models were down, and the reason for that is very clear. If you see the main indexes on the left-hand side, the Russell was down 1.7%, Bitcoin was down 9.21%, gold was up 2%, Treasury was down. We don't have money in treasuries. We don't believe in treasuries right now. And the Dow was up 0.41%, which is indicative of the breadth improving outside of tech. So overall, not such a great week for us, for our models. But I'm sure once the pullback happens, in Bitcoin, because it's down, for the year to date, it's down 0.36%, which is not good at all. So, but this is the right time to maybe put more money, right? When the market is down, you need to put more money in it. So if you're considering investing in cryptos, digital assets, I think this is a good time. And we have our metals and crypto portfolio, which is on the left-hand side, under the ETF models. If you see that, we are up 26% for the year. And the reason for that model has Bitcoin, Ethereum, which are obviously down, and then gold and silver, and both are up. So because of that combination, we can see a 26% return year to date. That was almost 46% when Bitcoin was up almost 40%, right? 26%. So it's down almost 26% right now from its all-time high. So reach out to us if you want to invest in cryptos, because I think this is the right time to dip some money into that, because you have to invest when others are fearful. You have to withdraw when others are greedy, right? That is the truth in which the market has to run. But most of the time, that is not how it works, right? It's all fear and greed works the other way around. Indian markets are running positive, and the global markets are also positive. It does follow the US markets, but if you look at the year-to-date performance of all the international models, they are doing very well. 24% on the ETF model, and India, China, Japan, all of them are up, big. So let's be positive, guys, and let's see how next week goes. I think Monday is going to be a good day, and then we will see a little pullback and then continue to go up, for the rest of the year. Because 18th was my cutoff. I had made this comment multiple times that 18th for me is the cutoff for the markets to behave negatively, and after 18th market should pick up. So let's see how it goes. And 18th is a good date from the astrological point of view and long-term cycles of equity markets, right? Astrology and long-term cycles of equity markets are kind of connected, because everything is finally connected to the sentiments of people, and sentiment of people is what drives the equity markets. And if the sentiment is down, market is down. If sentiment is high, market is up. That is how it works. Now coming to tax planning, we have another 40 days. A lot of our funds are getting full. 4 of our funds are completely oversubscribed, and that means you have to act fast if you are interested in lowering your tax liability for 2025. So these 2 slides that I'm showing you, I also explained these last week. For business owners, there are a lot of options to lower their income. They can put a lot of money in defined benefit plans, retirement plans such as solo 401k up to $70,000, SEP IRA $70,000. And for business owners who have more than 5 million in revenue, the options in fact increase even further. We have the risk mitigation insurance setup where you can write off almost $2.8 million per year, and defined benefit plans 400k per member, and then private foundation. If one has a charitable intent, we can create your own family foundation and try to put money in it and take a reduction and use that money for true charity, like giving it away to temples or doing some projects in India and things like that. And that makes sense, if you are able to put at least $100,000-$200,000 in the fund. Otherwise, the cost of it may not be meaningful to spend if the amount that you're planning to contribute is lower than $100,000. Next slide, please. And for real estate investors, we have more options. Go back, Jyoti. So for real estate investors, there are options. One slide back, Jyoti. Okay, so you can reduce all these expenses related to your investment properties. Then we can also do something called as engineering cost segregation study on your home and try to increase the bonus depreciation. Then opportunities on investments are also an option to lower your capital gains if from sale of homes or sale of stocks. And then we have a strategy for lowering income from sale of business or sale of stocks. So let's say you sold your Nvidia stock and generated $1 million income, capital gain. We have a structure where you put $100,000 and it gives you a 10 times the loss to write off against that $1 million income. So it's the 10x multiple, but this works for capital gains, and this works only if the gains are in excess of $2 million. It makes sense because you invest $200,000 and write off complete $2 million, that is realized gains. And on the charity side, for individuals, you can look at setting up a donor advisor fund. We do that. We can open a donor as advisor fund with Charles Schwab, and you put money in it, and that money grows, but the money that you contributed is deductible. So the money is in your control and you're not given it away. That's the cheaper version of setting aside charitable money but not really doing charity. The second option is private foundation, as I mentioned in the previous slide, but this makes sense for anything more than $100,000 because the cost of setting this up is close to $5,000. So it will be a private foundation like the Melinda and Bill Gates Foundation or the Berkshire Foundation. So this will be a foundation in your name. That means you have to incorporate it, apply for it, and then file tax returns for it every year. So the cost of it is higher. Where a donor advisor fund is easy. It's like opening a bank account. We just open it with Schwab, and we manage that money for you. And the money grows inside the foundation, and you don't have to spend any money for maintaining that foundation other than opening the account and seeing the money grow. Next slide, please. And both this charitable contribution, you can do up to 50% of your income. So someone making $500,000 income, up to 250K, you can do charity if your intent is to do long-term charity, right? Now there are some options that we have which generates much larger charitable contribution deduction, which is like 1:5x. So we have equipment donation strategy where you invest in this strategy, and if let's say you invest 50K, you can write off 250K. First fund is closed, the second fund is still open. It's not there on the slide because we usually talk only about real estate and other investments in our presentations and setting up your own foundation, but we do have that option available if you are interested. And for those who are not interested in giving away money towards charity, whether it is through your own foundation or your own donor advisor fund, or through the 1:5 land contribution or the equipment contribution plan, we have options where you can write off anywhere between 2 to 5x from your income as depreciation. We have the Florida Farmland Fund where you can write off 4 to 5x from your income up to $626,000 total. That is the maximum allowed for W2s, 650K. More than that you cannot. Even if you, let's say, put 200K and you get 800K write-off, you can only write off up to 650K. The balance will go to the next year. We have our own My Time Equity Fund where you can write off 2.2 times to 2.5 times of your investment. And this fund invests in gas stations, car washes, and equipments and cattle and things like that. But this fund is closed. We are not accepting any more money in the fund. We have already raised enough there, and we are trying to buy assets now. And in the oil and gas fund, the multiple is less than 1. So it's around 75 to 80% of your investment. And then we have two beautiful projects. One is called Tiffany Green Homes, This is about 8 miles from the Kansas City, Missouri airport. New homes, 2025 built, beautiful, properties, about 20 homes. You can check it out on our website, mytimeequitype.com, and you will see all the information there, pictures and all that. That generates about 5% income, 60% write-off of your investment. And it's a good property to buy, not just for depreciation, but for your family's list of assets. And the Florida short-term rentals are also great for good investment in the beach town of Panama City Beach. You get 60% write-off on your investment, so which means if you put 100K and stand guarantee for rest of it, let's say your total investment is 200K, 100K from loan, 100K from cash, that generates about 5% income, and your partner in the property, right? It's not like we are just giving 5% from nowhere. It's coming from the rental income, and you get 60% of the property value of your investment, not property value, 60% of your investment. So 60K on a 100K investment as write-off, because we will do the engineering cost segregation study. And then it's a good long-term property, beautiful property where you can actually go and stay. And this area in Florida has not been hit with hurricane for almost 70 years. So we did all that background check from last 3 months. Finally, we got 2 properties. One property I'm buying myself. 2 properties, we have listed it. We are trying to get one more for this year. But next year, I think we will do a lot more in some of these beach areas where it makes sense to do short-term rental properties through Airbnb and Verbivo and all that. And that qualifies for writing off depreciation for even W2 recipients. And last but not the least, nothing connected to tax strategy, but we have investment opportunities in late stage AI-based tech companies. The ones that we have open right now are Vast, which is in space tech. Then we have Glean, Mistral. We had Databricks, I think that's gone. But if you're interested in any of these companies, just go to our website, mytimeequitype.com, and please express interest there. And if we find the shares, if you don't have it, we'll find it for you, and we'll make sure that you have access to all of this, right? So our goal is to give you access to diversified types of assets and ensure that your portfolio is diversified, because anything can go wrong, anything can do very well, so we have to be diversified in our investment. There is no one single trick that can make your money grow the way you want. Next slide, please. So structured notes, time for structured notes. So we have this one structured notes. Unfortunately, this is ending on November 18th. Now this is a beautiful fund, but the return on it is not going to be like 20%. This is going to be a very well diversified fund, which will generate anywhere between 10.8 to 11.2% per year, and it will be paid every month. And it has a principal protection of 50% on the downside, and you will keep getting income every month as long as these shares or these ETFs don't go below 30 or 50%. ETFs have a 30% barrier, and equities, stocks have a 50% barrier. The minimum investment for this is $10,000, and there is no way we can extend the date. It is going to be 18th November. And this is good for those who are concerned that they are doing one single stock or 3 stocks. This is good for those because it is well diversified across ETFs and stocks. 49% is ETF exposure and 51% is stocks. And excellent stocks, all kinds of stocks, large cap, mid cap, small cap, and all sectors, tech, financials, healthcare, consumer, discretionary, and others. And on the ETF side, we have SPY, which are the 500 US's best companies, NASDAQ 100 technology companies, Dow Jones, Russell, small cap, Russell Index, not stocks. And then we have, the international markets and emerging markets. So this is a beautiful fund and giving good income, and it has memory built in for equities, so that is another good thing. Equities can go down below 50, then we have equities. And the most important thing here, guys, which has to be kept in mind, this will not be called for 3 years. So a lot of our clients are not happy with the 3-month call that applies to income notes, right? Here, this will not be called for 3 years. So once you make the investment, you will be making between 10.8 to 11% every monthly payment, for 3 years. So, and you can exit out of it whenever you want. It has the NAVs, daily NAVs calculated. So if it's liquid, it's high yield, it's diversified, and it is a bunch of equities and ETFs across multiple sectors and multiple countries. I don't think I can offer anything better than this for those who are happy with the 10.8 to 11% income, and it will be paid as income. This is not capital gain. This is going to be income, right? So this is a very good fund, and this fund is closing on 18th November. The next fund may be in December, but we have this option open. If you're interested, please write to wealth@mytimeequity.com. Next slide, please. This note is trading on 21st November. This is on Apple, Nvidia, and Palantir. Like one of our normal notes, but the returns are extremely good. Market is down right now, so good time to put money, right? Because you will not only get 50%, 40% barrier, but you will also have extra space, because you are investing when the market is down, not all-time high. So we make 52.05% at the end of year 1 if all the stocks are more than 80%. Okay, it's not 100%, 80%. So you have more protection there. And if it is not at the end of year 1, then you make 2.5% at the end of year 3, 2.8 times, 2.5 times of the lowest performing stock at the end of year 3. Solid stocks, Apple, Nvidia, Palantir, with 40% downside protection, 3-year note, first year 52% if it gets called, otherwise 2.5 of the lowest performing stock. So good trade. We have time, no rush, 7 days. So take your decision and let us know. Next slide, please. So this is on Google, Nvidia, and Meta, and this is similar note. It has 60% at the end of year 1 or 3.5% at maturity. One of the two. Most probably, if the market continues to do well next year for the next 12 months, you will get your 60 or 52% in the previous one. Otherwise, if the dip comes in the market, if recession hits, if it does, which I don't think it will, a market may come down, but I don't see a recession happening unless there is some real fraud or bad event that takes place, like Enron or some big problem. I don't see a recession, but I do see market correcting, because market corrects once in a while, and we did see that during the Liberation Day in April. So that's where again it may happen next year, but again you don't know when that will happen and at what point that will happen. So being invested in the market all the time is the best thing to do. Next slide, please. Okay, so that brings us to the end of the presentation. So guys, if you have not joined our WhatsApp group, please join the WhatsApp group. You have the QR code here. Just show your camera to this and you'll automatically join. And if you have any questions, please call us. When you call us, it may not be getting answered immediately, but leave a message or email is the best. Wealth@mytimeequity.com is the best. So just message us via email and we'll be happy to answer any questions. So let me take questions. Today we don't have Anup here on this webinar. He has gone for an event, participating in an event. We have a booth there and he's taking care of that. So Jyoti and I are managing this today. But if you have more questions, please keep posting it and we'll be happy to take them. So the first question is by what date donor advisor fund we established for 2025? So for any tax planning, you have to do it before December 31st. Now the problem of these next 2 months is we have too many holidays and the banks are not as efficient. So getting loans, opening accounts and all is hard. So if you're planning to do it for 2025, the practical deadline I would say is Christmas, December 26th. And if you're trying to invest in the fund, the practical deadline is Thanksgiving weekend, which is 26th of November. So please do let us know. I already have a foundation. How much can I contribute to charity? So if you already have a foundation and it is approved by the IRS under the 506 section, you can contribute up to 50% of your AGI or adjusted gross income. Or if you're contributing cash, you can go up even higher. If you're contributing kind, it is 30%. If it is contributing cash, 50% and higher. We will have to look at the exact number, but 50% is a huge percentage of your AGI. And if you have a corporation, which is a C Corp, you can do up to 10% of its income. So those are the 3 governing rules for charity. Just curious to know how we can write off 5 times through farmland. So this farmland has invested in citrus groves. Now the big beautiful bill, which got signed recently by President Trump, and now it is Big Beautiful Act. So this particular project is investing in these citrus groves, and since we can depreciate these groves, these trees, you get a high write-off. And number 2, there is something called a step-up in basis. By using that strategy, the write-off goes as high as 3 to 5 times. It will be more or less near 4. Again, all of this will be determined next year when the engineers will do the full study, and how much is the leverage, how much is the bank loan for this particular project. It depends on all of that calculation. So when we are trying to offer this to you, we typically say it's anywhere between 3 and 5, but conservatism says 3, moderate says 4, most aggressive says 5. How much it is going to be, it will only be determined when the K1s are issued next year. If one of the stock in the structured note goes below 50%, what is the impact on income? Will it be 0 for the entire equity part or smaller participation, proportional hit? That's a great question. So we have 2 types of barriers in these income notes. One is the principal barrier and one is the coupon barrier. And if the coupon barrier is 50%, and if it goes below 50, if one of the stocks, then the income flow stops. But what we typically do, we add a feature called memory. When we include memory in the note, whenever the stock comes back up, you end up getting paid for the unpaid months. So that is the feature that we add. So you don't end up missing the payment if the stock subsequently goes up, right? So that is how it works on the income side barrier. For income fund, is the principal protected 100%? For the income fund, we have a 50% barrier. Jyoti, if you could go back to the income fund note. It has a 50% barrier for principal, for equities, and for indexes, it has a 30% barrier. If you see this slide under barrier, it says index linked notes, 70% principal and coupon also. So it means 70% means 30% is the barrier. And for equity notes, for principal and coupon, it is 50% barrier. And it includes memory for individual stocks, not for indexes, because indexes are pretty stable, right? There are too many stocks in it and different sectors and all that, different geographies. But for individual stocks, we have the memory feature included in this. In the 51% stocks, 49% index, barrier applies to each of the individual stock. Yes, it applies to each of the individual stock. Now what I'm showing you here is a one single slide listing all the names of the stocks and all that. It is not listing the weights of each of the stock, each of the index. Now when you write to us via email, and if you are interested in it and tell us how much you are interested in investing, we will send you the rest of the information like prospectus and things like that. And after you read the prospectus is when you make the decision. But all of that should happen before 18th. So please let us know. What are the hours requirements to claim depreciation against W2 for farmland fund? It is 100 hours for farmland fund. And for depreciation on farmland, do I need to be an active investor, meaning if I contribute more than 50%? No, you don't have to be, because farmland has certain exceptions. Short-term rental, Florida property has certain exceptions. So if you are looking at a pure play depreciation benefit, you should look at either the farmland or the car wash. Farmland has higher write-off, but the not so good thing about the farmland, it's a long-term project. It may go up to 10 years, whereas a car wash project may be a 3 to 5 year play. Car wash has 2.2 times write-off based on our pro forma, and the farmland has between 3 and 5 based on the pro forma. Farmland, the income is around 3 to 5% per year, and it's paid annually, not monthly, whereas the car wash fund has 3 to 5% and it's paid either monthly or quarterly. And the hold period for farmland is much longer, whereas for car wash, it is much shorter. And the Florida property and the Tiffany Greens in Kansas City, I think if you are looking beyond depreciation, if it is something that you would like to own for a long period of time as a single asset, like for example, I like to own a beachside property where I can also go and stay if I want to, by paying the fees, obviously, because it will be on Airbnb. So it's good investment. Or if you like homes, right? Because homes are quite resilient, and 20 homes, 8 miles from the Kansas City airport, it's very hard to buy. And all of these are new constructions, 2025 construction, 2024 construction. These are beautiful properties which you should just buy and hold it in your portfolio and generate that income and get the depreciation and let it ride, right? Can IRS challenge the K1 is active for car wash if I am not a real estate professional? Yes, the IRS can challenge. IRS has not been having good amount of labor to challenge a lot of things. They are still figuring out problems with privacies, false calls coming from various parts of the world and going behind the super rich. So there are a lot of challenges that IRS is facing right now. It doesn't even have a commissioner. It's right now Scott Bessent, who is the acting commissioner, over and above his responsibilities of playing the head of treasuries. He also is managing IRS now. So I think IRS is going to be, again, keep in mind, Trump focused a lot on international issues, and now he's focusing on domestic issues, right? You see him now touching on Medicare, government shutdown is sorted out. I think the next 6 months till midterm, the focus is all going to be on domestic. So that is where the impact of tariff will be known, the impact of IRS defunding, cutting labor, the impact of DOGE, cutting all the government workers, all of that will be known in the next 6 months, and the focus is going to be more domestic next 6 months. What are the available investments to take advantage of depreciation without being an active investor? So oil and gas is a good opportunity to invest without having to lock time and things like that. The short-term rental in Florida is another such opportunity to invest. And both these opportunities are not pure play write-off with a huge multiple, because oil and gas generates 75 to 85% write-off of your money that you invested, and short-term rental generates anywhere between 50 and 60% of your money invested. But oil and gas project gives you income, consistent income for 15 years plus. But the risk is the risk of price of oil going down, gas going down, long-term hold, money not coming back. Whereas a short-term rental property is the best option for those who cannot sleep well at night with these active passive types, as well as trying to own the best asset on a farm on beach in Florida. And another point for you guys is because of all these fleeing of people happening from New York after Mamdani's win is a big push for Florida real estate. I think we'll see Florida real estate do extremely well, particularly beachside towns and and some of the big cities like Miami and some of the agricultural lands that we are buying in Venus, Florida, or Vero Beach, Florida, and all. So guys, thank you very much for your time today. It's 11:50. We are just 10 minutes away. We don't have any more questions, but you know how to reach us. We constantly keep putting messages in the WhatsApp group on a daily basis, and also all our offerings. And if there is anything we could do to help, if there are some ideas which you think we have to implement, then we are very open to such creative ideas. So please let us know. Write an email to wealth@mytimeequity.com. If there is any late stage pre-IPO company that you want us to bring to your attention, do let us know. Happy to help. Okay, one more question here. When my CPA says Airbnb properties, when jointly held, only one will get depreciated. So when you're jointly, when you're filing your joint return, it doesn't matter whether you are doing the work or your spouse is doing the work. It is considered joint. Together, if you spend more than X number of hours, that is considered good for active and passive participation. So folks, once again, thank you very much, and we look forward to talking to you again next week. Let's hope next week is a green week and Bitcoin comes back up and all the crypto start pumping up. And you guys have a great rest of the weekend, and we'll talk to you next Saturday. Thank you very much, and thank you very much, Jyoti.
Thank you.